On August 15, 1971, President Nixon walked into a television studio and, in 18 minutes, destroyed a monetary system that had anchored global finance for 27 years. By the time he finished speaking, every dollar in your wallet had fundamentally changed, though it would take 8 years for Americans to feel the full consequences. Picture the scene at Camp David that weekend. Treasury Secretary John Connally paces the presidential cabin while Federal Reserve Chairman Arthur Burns sits quietly reviewing charts showing America's gold reserves hemorrhaging at an alarming rate. Nixon knows he has a choice: honor our promise to exchange dollars for gold at $35 per ounce, or close what insiders call the gold window forever. The numbers told a stark story. France had just demanded $191 million in gold for their dollars. Britain wanted $3 billion more. Our gold reserves had dropped from 20,000 tons in 1950 to just 8,100 tons by 1971. At this rate, Fort Knox would be empty within 2 years. But here's what should grab our attention. Nixon wasn't just ending a policy. He was conducting the largest monetary experiment in human history. For the first time since 1792, American money would have no backing except the government's promise to accept it for taxes. The world's reaction was swift and brutal. European markets opened Monday morning and immediately devalued the dollar by 8% overnight. Currency traders in London, Frankfurt, and Tokyo understood what many Americans missed. We had just made our money purely political. Think about what this meant for you as an American. That $20 bill in your pocket had always represented a specific amount of gold. Suddenly, it represented nothing more than the government's credibility. Your savings, your paycheck, your retirement funds, all now backed by trust alone. The Federal Reserve found itself in uncharted territory. Chairman Burns faced a dilemma no central banker had confronted before. How do you manage a currency with no anchor? Gold had always provided automatic discipline. Print too much money, and gold would flow overseas as foreigners lost confidence and demanded real assets. Now that discipline was gone. The Fed could create money without immediate consequences, but they had no reference point for knowing how much was too much. It was like flying a plane without instruments in a thunderstorm. The immediate crisis came in waves. First, foreign governments began questioning whether dollars were worth holding at all. The Japanese finance minister publicly suggested that America had defaulted on its international obligations. European central banks started accumulating gold and rejecting dollars for major transactions. Then came the oil shock of 1973. OPEC nations, led by Saudi Arabia, initially demanded payment in gold instead of dollars. They understood that Nixon had just devalued their oil revenues by abandoning gold backing. The negotiations that followed would reshape global finance. But in 1971, it looked like America might lose its ability to purchase the world's most critical commodity. What happened next reveals everything about how currency systems actually work. Without gold backing, the dollar's value became purely psychological, based on whether foreigners believed America would remain powerful enough to make dollars valuable. This put enormous pressure on U.S. officials to demonstrate strength through other means. The sterling crisis of 1976 showed Americans what currency collapse looks like in practice. Britain, facing similar credibility problems after abandoning gold backing, watched the pound lose 40% of its value in just 2 years. British citizens saw their savings evaporate while inflation soared above 25% annually. Britain was forced to borrow $3.9 billion from the International Monetary Fund, the largest loan in IMF history at that time. The conditions were humiliating: spending cuts, tax increases, and monetary policies dictated by foreign bureaucrats. British sovereignty had become negotiable. American officials watched this crisis with growing alarm. If the dollar faced similar credibility problems, who would bail out the world's largest economy? The Federal Reserve understood they were walking a tightrope. Print too little money, and recession would follow. Print too much, and dollar collapse might destroy American prosperity. The deeper problem was structural. Gold had provided what economists call automatic adjustment. Countries running trade deficits would lose gold, forcing them to reduce imports and balance their accounts. Countries with surpluses would gain gold, encouraging them to spend more and restore equilibrium. Without gold, these automatic adjustments disappeared. America could run unlimited trade, deficits simply by printing dollars to pay foreign creditors. But this created a time bomb. Eventually, foreigners would accumulate so many dollars that continued acceptance would become irrational. By 1979, that moment was approaching fast. Inflation had accelerated from 3.3% in 1971 to over 13%. The dollar had lost 35% of its value against major currencies. American tourists found their money increasingly unwelcome overseas. Foreign central banks were quietly reducing their dollar holdings. Most telling of all, gold prices had exploded from $35 per ounce in 1971 to over $500 by 1979. Markets were sending a clear message. Investors preferred real assets to paper promises. The monetary experiment that began at Camp David was creating exactly the crisis Nixon had tried to avoid. The Federal Reserve faced an impossible situation. 8 years of trying to manage a pure fiat currency had created inflation expectations that threatened to spiral out of control. Every economic decision now carried political consequences because money itself had become political. What Nixon had unleashed in that television studio was about to force the most dramatic monetary policy response in American history. The solution would come from an unlikely source, a tall, cigar-smoking Federal Reserve chairman named Paul Volcker, who understood that saving the dollar would require breaking the American economy first. The stage was set for a monetary shock that would make Nixon's gold window closure look modest by comparison. October 6, 1979. A Saturday evening in Washington, D.C. Most Americans were watching television or preparing for Sunday family dinners. But inside the Federal Reserve Building, Chairman Paul Volcker was about to deploy what financial historians now call the Saturday Night Special, an interest rate shock so severe it would reshape American finance forever. Volcker understood something his predecessors had missed. Saving the dollar would require breaking the psychology of inflation. Americans had learned to expect rising prices, and that expectation was becoming a self-fulfilling prophecy. Workers demanded higher wages to offset inflation. Companies raised prices to cover higher labor costs. The cycle fed on itself. Here's what made Volcker's approach revolutionary. Instead of gradually raising rates and hoping for the best, he decided to shock the system with brutal force. The federal funds rate jumped from 11.2% to 15.3% in a single Federal Open Market Committee meeting. Banks that had borrowed money Friday at reasonable rates found themselves paying loan shark prices by Monday morning. Think about what this meant for ordinary Americans. Your credit card rates, which had averaged 12%, suddenly spiked above 20%. Mortgage rates climbed past 18%, making home buying impossible for most families. Small businesses found themselves paying 22% to expand operations. The American economy began to seize up like an engine without oil, but Volcker wasn't finished. By March 1980, he had pushed the federal funds rate to an unprecedented 20%. No central banker in modern history had deliberately created such punishing borrowing costs. The political pressure was enormous. Home builders mailed chunks of wood to the Federal Reserve in protest. Farmers surrounded Fed buildings with tractors. Congressional leaders demanded Volcker's resignation. The human cost was staggering. Unemployment soared from 5.8% to 10.8% in just 18 months. Factory towns across the Midwest became ghost communities as manufacturers shut down, rather than pay crushing interest rates. The recession of 1981 to 1982 would be the worst since the Great Depression, throwing 12 million Americans out of work. Yet something unexpected happened during this economic carnage. The Treasury Department discovered it could no longer borrow money the traditional way. With long-term interest rates approaching 15%, issuing 30-year bonds became financially impossible. Who would buy government debt that paid crushing rates for 3 decades? Treasury Secretary Donald Reagan faced a cash flow crisis. The government still needed to fund operations, pay Social Security benefits, and service existing debt. His solution would accidentally create the financial system we live with today. Massive issuance of short-term Treasury bills to meet immediate funding needs. Here's where the story gets fascinating. Instead of borrowing money for 10 or 30 years, like normal governments, America began borrowing for 90 days, 6 months, or 1 year at most. This wasn't a deliberate policy choice. It was emergency management. Long-term borrowing had become too expensive, so Treasury officials grabbed whatever short-term funding they could find. The numbers tell the story perfectly. In October 1979, when Volcker launched his shock therapy, Treasury bill issuance stood at $45 billion annually. By 1982, that figure had exploded to $400 billion, a tenfold increase in just 3 years. America had accidentally discovered that short-term desperation borrowing could fund long-term government operations. But who was buying all these Treasury bills? The answer reveals how Volcker's crisis created an entirely new financial ecosystem. Money market funds, which barely existed before 1979, suddenly became the Treasury's primary creditors. Here's how this worked in practice. When Volcker raised rates to 20%, ordinary Americans fled traditional savings accounts paying 5% interest. Money market funds offered them 15% returns by purchasing Treasury bills and commercial paper. Fund assets exploded from $76 billion in 1979 to $236 billion by 1980, the fastest growth in financial history. Think about what had just happened. The Federal Reserve created a crisis that forced the Treasury into short-term borrowing, while simultaneously creating the demand for that borrowing through money market funds. Americans were unknowingly funding their own government's desperation through these new financial vehicles. The beauty of this system, from Washington's perspective, was that it appeared to solve multiple problems simultaneously. The Treasury got funding without issuing expensive long-term debt. Money market funds earned huge profits by connecting government desperation with citizen savings. The Federal Reserve maintained control over interest rates by influencing short-term markets. Most importantly for Volcker's inflation fight, this system created automatic discipline. If the government printed too much money or spent too recklessly, money market fund managers would demand higher rates for Treasury bills. The market would punish fiscal excess immediately rather than waiting for long-term consequences. By 1982, Volcker had broken the back of inflation. Consumer prices fell from 13.5% annually to just 3.2%. The dollar strengthened dramatically against foreign currencies. America had proven that a fiat currency could maintain value through sheer force of monetary will. But the victory came with a hidden cost that wouldn't become apparent for decades. The emergency borrowing system that funded government operations during the crisis had become permanent. Short-term Treasury bill issuance, which had seemed like temporary crisis management, was now the foundation of American public finance. Consider what this meant for American fiscal policy going forward. Before 1979, the government could borrow money for 30 years and forget about refinancing until the next generation. After Volcker's shock therapy, massive amounts of government debt needed to be rolled over every few months. This created constant pressure to keep money market funds happy and maintain their appetite for Treasury bills. The Federal Reserve had accidentally created what economists call duration mismatch, funding long-term government operations with short-term debt. This made America financially dependent on the confidence of money market fund managers who could withdraw funding at any moment if they lost faith in government creditworthiness. Even more significantly, Volcker's crisis response had institutionalized the very financial instability it was designed to cure. The government now needed to constantly refinance massive amounts of debt, making it vulnerable to interest rate shocks, funding crises, and market panic. America had traded long-term financial stability for short-term crisis management. The pattern was set. Every future financial crisis would follow the same playbook: emergency short-term borrowing, money market fund expansion, and Federal Reserve intervention to maintain system stability. What began as Volcker's desperate response to Nixon's monetary experiment had become the operating system of American finance. Foreign observers understood the implications immediately. European central bankers quietly noted that America had made itself dependent on the very financial markets it was trying to control. The dollar's strength now rested not on gold backing or economic fundamentals, but on the continued willingness of money market funds to finance government operations. By the mid-1980s, this system was generating enormous profits for financial institutions, while creating permanent instability for government finances. Primary dealers who bought Treasury bills directly from the government earned guaranteed spreads by selling them to money market funds. Fund managers collected fees on assets that grew automatically as government borrowing increased. The biggest winner was the Federal Reserve itself, which had discovered that controlling short-term interest rates gave it unprecedented power over the entire financial system. By influencing money market fund returns, the Fed could essentially dictate government funding costs and private sector borrowing conditions. What Volcker had created wasn't just a solution to 1970s inflation, it was a machine for converting government financial desperation into private sector profits. This machine would hum quietly for decades, growing larger and more essential with each crisis, until it reached the breaking point we're witnessing today. December 2024, a routine Tuesday morning in Washington, D.C. While most Americans were finishing their holiday shopping, Treasury officials were conducting the largest single short-term debt auction in American history, $100 billion in 4-week Treasury bills. To put this in perspective, that's equivalent to the entire annual bond program of the United Kingdom, borrowed for just 28 days. The casual announcement of this massive borrowing reveals how completely Volcker's emergency measures have become normalized. What would have triggered congressional hearings and front-page headlines in 1980 now merits a brief Treasury Department press release and scattered coverage in financial media. Here's what should alarm every American. This isn't crisis borrowing anymore. It's the system working exactly as designed since 1979. The $100 billion T-bill sale represents the inevitable endpoint of the post-gold monetary experiment that Nixon began and Volcker institutionalized. Let's trace how we arrived at this moment. The 2008 financial crisis provided the perfect opportunity to expand Volcker's emergency tools into permanent fixtures of American finance. When Lehman Brothers collapsed, Treasury Secretary Henry Paulson dusted off the 1979 playbook and applied it on a scale that would have shocked even Volcker himself. In March 2020, the Treasury issued $3 trillion in emergency debt to fund pandemic response. Here's the critical detail. 75% of this borrowing came in the form of bills with maturities under 1 year. The government was essentially putting the entire pandemic response on America's credit card, with minimum payments due every few months. Money market funds, descendants of those created during Volcker's crisis, absorbed this debt eagerly. Fund assets swelled to over $6 trillion as Americans sought safe returns during economic uncertainty. The system had scaled beyond anyone's imagination, but it was still following the same basic pattern established 45 years earlier. Think about what this means for your financial future. Every dollar in money market funds represents debt that must be refinanced constantly. Your safe savings are actually funding a government borrowing machine that can never be turned off. The Treasury needs these funds to roll over existing debt, pay current expenses, and service the interest on previous borrowing. The numbers reveal the scope of this dependency. Foreign central banks, once reliable buyers of long-term Treasury bonds, have been reducing their holdings steadily since 2021. They've sold over $600 billion in Treasury securities, the largest foreign sell-off since 1978, when dollar confidence collapsed during the Carter administration. This foreign retreat forces even greater reliance on domestic money market funds and short-term borrowing. When China reduces Treasury holdings by $100 billion, those securities must be absorbed by American money market funds, or the system faces a funding crisis. Each foreign sale increases our dependence on the very financial mechanism Volcker created during his emergency. The $100 billion 4-week T-bill auction perfectly illustrates this dependency. Foreign demand for long-term Treasury bonds continues declining, forcing Treasury officials to meet funding needs through shorter and shorter borrowing periods. 4 weeks represents the extreme end of this trend, borrowing so short-term that it must be refinanced 13 times per year. Who profits from this system? The winners are exactly who you'd expect. Money market funds collect management fees on $6 trillion in assets, earning billions annually from government financial desperation. Primary dealers who purchase Treasury bills directly from the government earn guaranteed profits by reselling them to fund managers at higher prices. The Federal Reserve maintains ultimate control by setting the interest rates that determine money market fund returns. When the Fed raises rates, fund yields increase, attracting more assets and providing more funding for government borrowing. When rates fall, the opposite occurs, forcing the Treasury to adjust borrowing strategies accordingly. Meanwhile, ordinary Americans face the hidden costs of this system. Money market fund returns consistently lag inflation, meaning savers lose purchasing power while their funds subsidize government operations. The constant refinancing of government debt creates interest rate volatility that affects mortgage rates, credit card payments, and business lending costs. Foreign creditors who trusted American promises for decades watch their Treasury holdings lose value through currency debasement and inflation. What they thought were safe investments in the world's reserve currency have become vehicles for gradual wealth transfer from foreign savers to American borrowers. The most damaging cost falls on taxpayers, who must fund exponentially rising interest payments on constantly refinanced debt. In 2024, the federal government spent over $1 trillion on interest payments alone, more than the entire defense budget. Much of this goes directly to money market funds and primary dealers who profit from the government's inability to borrow long-term. Here's what makes December 2024's $100 billion auction so significant. It represents the normalization of financial extremes. Borrowing $100 billion for 4 weeks would have been unthinkable during any previous era of American history. Today, it's routine business conducted without political debate or media attention. The Treasury Department isn't panicking about this borrowing. They're following a 45-year playbook that has successfully funded government operations through multiple crises. Officials understand that money market funds need places to invest their assets, and Treasury bills provide the safest option available. It's a symbiotic relationship that benefits both parties while creating systemic risks for everyone else. What we're witnessing isn't the failure of American finance. It's the logical conclusion of choices made in 1971 and 1979. Nixon removed the gold anchor that provided automatic discipline over government spending. Volcker replaced that discipline with market-based mechanisms that turned government desperation into private profit. The $100 billion T-bill sale shows this system operating at maximum efficiency. Government funding needs are met immediately through short-term borrowing. Money market funds earn fees while providing liquidity. Primary dealers collect spreads for facilitating transactions. The Federal Reserve maintains control over interest rates and system stability. The only problem is sustainability. Every 4-week borrowing cycle requires finding another $100 billion in funding. Every refinancing depends on money market fund managers maintaining confidence in government creditworthiness. Every interest payment increases the total debt that must be rolled over in future auctions. This is the endgame of the monetary experiment that began 53 years ago. A financial system so dependent on short-term borrowing that it cannot function without constant refinancing of massive debt loads. The machine Volcker built to solve the 1979 crisis has become too large and essential to ever be shut down. Americans watching their savings lose value to inflation, their tax dollars disappear into interest payments, and their currency weaken against real assets are witnessing the final act of a monetary drama that began when Nixon walked into that television studio. The $100 billion T-bill sale isn't a crisis. It's proof that the system is working exactly as designed, turning government desperation into private profit, one short-term auction at a time.